Hi everyone and welcome to the Everyman Investor. I'll cover a different investment vehicle today. As you can see from this nice house with a very beautiful backdrop, I'll be covering real estate and investing in real estate today. So real estate consists of two groups. This is commercial real estate, which most people will probably not know much about. And then of course the one that we're very familiar with, which is residential real estate. So what is the difference? Now, if you're investing in residential real estate, typically the lease on your property is shorter. Tenancies usually last for about 1 to 2 years. The vacancies are shorter as well because vacancy rates are very low nowadays due to the housing crunch and the increasing number of people wanting to rent. There's a higher loan to value ratio which you can borrow from the bank to mortgage on your property. So usually you have to pay about 20% down payment, and the rest of the 80% of the value of the property you can borrow it from the bank. And the rental yield is about 2 to 6% depending on your property as well as the location. And capital gains are variable. So usually the property with the bigger land size will get greater capital gains than properties with smaller land sizes. Typically land appreciates and the structure depreciates. So that's why houses usually have better capital gains than apartments, and townhouses are smack in the middle between apartments and houses. Now, for commercial real estate, the lease usually is longer. In fact, many commercial real estate leases have got options to extend. So basically, for example, say you have a 5-year lease with option to extend for another 5 years and another 5 years and so on. Vacancy rates usually are longer because to find an individual tenant is a lot easier than to find a business to rent your commercial real estate property. And the loan to value ratios that you can obtain from mortgage from the bank is usually lower. So in general, about 60% of the value of the property can be borrowed from the bank, and you have to save up about 40% of the value of the property as a down payment. Now, rental yields are higher to compensate for the lower loan to value ratio as well as the longer vacancy period. So rental yields can be from about 4 to 10% depending on what kind of property you own. Again, capital gains are variable depending on the location and also what the property is zoned to allow a business to function. Now, so we start with residential real estate. So usually the most common sort of debate is between investing in an apartment versus investing in a house. Now, apartments have got benefits. So usually the capital gains are lower because they have lower land value. So usually about 2 to 3% capital gains per year. Now, rentals are usually higher, and this is the benefit of apartments. Because you pay a lower upfront amount, the amount you get from your rental usually is a lot higher. So usually 3+% yields per year are usually common. But the problem is that apartments, because they are part of a complex, have got management fees and also sinking funds. You need to pay the people to basically manage the property you have and to trim the trees, manage the pool, clean the pools and stuff like that. The initial cost is usually lower compared to a house, and the land tax or property tax is usually lower because the land value is lower. Now, for houses, usually capital gains are higher because of the land value appreciation. So about 6 to 8% a year is not uncommon. But rental yields are usually lower because of your initial outlay, which is higher. So about 2+% rental yields are considered as quite common. Their outgoings depends on local factors. So different countries, different areas of the country will have different sort of fees you have to pay if you own a house. The initial cost is of course usually higher than an apartment unless you're buying one of those swanky, huge apartments, top floor penthouse units with their own pool and sort of thing. And the land tax or property tax is usually higher because of the land value is higher as well. Now, commercial real estate, as I mentioned, has got different zones. So, healthcare is one of the zoning users of commercial real estate, and healthcare is an essential service. Usually, if you can lease out your property, if it's zoned for healthcare, you can lease out to, say, a doctor or allied healthcare professional, for example, a psychologist or a physiotherapist. Most of the time, that is considered as a good tenant to lease it out to, and especially if the business goes well, usually you can lease it out for a longer period of time at a good yield. Now, then there's industrial and warehouse. So basically, these are sort of either like industry properties where they can sort of do construction and stuff like that, or warehouses. And usually, if it's leased to a good tenant, the demand usually is very resilient because someone who has got, like for example, construction machinery in that property they have leased will not want to move all these things all about the place every few years. Now, unless of course your tenant goes bust, in which case then you're stuck with the property and you have to find another tenant to lease it again. And then there's rural and farming. So sometimes people actually buy farmland to lease out to farmers. I have never actually seriously explored this option because frankly it is all Greek to me. But the location and climate considerations are important depending on who you want to lease it to. And a good commercial real estate agent who has got experience in this area will probably be a good person to talk to. Then there's hospitality and retail, which is the most dependent on economic conditions. So the COVID sort of lockdowns have caused a lot of retail and hospitality, restaurants, cafes, and stuff like this to close down, and demand is still very soft in that area. And lastly, there's office. So office spaces are one of those, I would say, difficult commercial estate properties to think about at the moment in time because work from home trends are very strong. Many workers who have worked from home do want to continue working from home, but at the same time, there are companies that are forcing their workers to return back to work at least a few days a week. So, in all these different zones, I would say that the best commercial real estate to invest in will be healthcare and industrial warehouse. Or if, for example, say you want to buy over a room in a hotel or service apartment, and then the hotel or service apartment leases that room back from you. But then again, you must remember that if the room needs sprucing up or any renovations, then you are responsible as the person who owns that property actually. Now, what are the factors that affect your yield? So, of course, interest rates, which affect your mortgage payments, and then there's always outgoings. So you must check for what outgoings they are: council rates, water rates, owner corporation fees, building insurance, for example, and locations. So usually, the best areas are metropolitan areas, the built-up areas, or holiday areas, or if you have got a up and coming suburb that has got very big infrastructure sort of investment going on, then these are areas that you can look into. And connectivity is very important. So public transport and road infrastructure are very important factors in a tenant deciding whether or not to lease your property. And also amenities. So education institutions are very important, especially for young families, and also shopping and entertainment for the sort of younger adults and for the middle-aged adults. So let's talk about mortgage calculations. So I'm going to go low. So we start with a $500,000 residential property, which you need to pay 100K, 20% down payment, and then you can loan 400,000 from the bank. Now, let's say a 7% interest rate, although I heard that interest rates are now at 8%, and a 30-year loan. So basically, you'll be paying $2,661.21 per month for the next 30 years, and your total interest payment is more than $500,000, which is basically more than what your property was worth when you first bought it. And this is assuming you have principal reduction in your payments. Some people pay interest-only loans, but that is a problem because in order to get back money from a property, you actually have to sell at a higher price. And depending on where your property is, sometimes prices actually go down rather than go up. So that can be a problem. And remember that your mortgage calculations are not the only factor that affects your yields. There's property tax, your tax on your rental income, insurance, and any other outgoings like renovations and stuff like that if you need to do that. Now, there are alternative ways to invest in property. So you can go for real estate investment trusts, which basically are listed companies that will rent out the properties that they have bought, and then they'll pay you your dividends from a percentage of the profits that they earn from leasing out the properties. But the problem is that these are all stocks and there is volatility from equities as with all stocks. Now, the other option that I found is actually fractional ownership. So if you search fractional ownership, there are many websites available. What happens is that you pool, say for example, 1,000 people, or maybe I say 100 people who want to buy a property, and then you buy a $500,000 property, so each person only pays $5,000. But then the thing is, you will have your profits either from capital gains or your rental will be shared between that number of people, which means to say that you will get a lower return, although the percentage return based on what you put in is actually the same if you own the property outright on your own. But then again, liquidity is a problem, because if you own the property yourself, you can sell it at any time. But if you own it as part of a fractional ownership agreement, you can either sell it to someone else who wants fractional ownership, or if everybody or majority of the fractional owners decide to sell it, then you can probably sell it. But getting many people to agree on something is a problem nowadays. So in conclusion, I would say that the best real estate investment is your own house, because you will save on things like if you're going to pay rental, for example, for a property, your rental can be actually used to pay off your mortgage, and then you get the capital gains from your house. So if you buy a house and you decide to retire in an apartment that is easier to upkeep, then you get back cash, plus you can pay for your apartment in cash, for example, without having to take a loan in your retirement years. Subsequent investments other than your own house basically involve very meticulous cost versus gains calculations to make sure that you get good yields. The lower the initial loan, the higher the yield. So that is where apartments as an investment may be better than a house. Alternatives like REITs and fractional ownership are lower cost options, but they have their own risks, as I mentioned previously. And if you're thinking about short-term rentals for your property, there's a lot of legislation nowadays to help limit either the number of days you can rent it out as a short-term rental, or they increase the tax that you have to pay on your rental use, or you have to apply for approval. And given the housing crunch nowadays, it's likely that these headwinds are going to be persistent for the next 3 to 5 years at least, until the housing sort of supply catches up with the demand. So I hope this was useful if you're considering investing in real estate, and thank you for watching this video, and I'll see you in my next video where I cover another different investment vehicle.